Congratulations! You are now part of a worker cooperative. Whether you are a co-op member or on track to become one, it is crucial that you understand how worker cooperatives compensate their workers. In this video, we will go over the different ways in which members and member candidates are compensated for their contributions to their co-op. But first, let's review some basics. Having a job in a worker cooperative means an opportunity for co-ownership in a democratically controlled workspace. Membership means co-ownership, and members equitably share in the benefits and the responsibilities of co-owning a business. In almost all cases, there is a trial period, also known as a candidacy period, that begins when a person starts working in the cooperative. If the cooperative is organized as a cooperative corporation, new workers who join are employees and must complete a candidacy period before being eligible for co-ownership. The required time and procedures to become a member, as well as details for member compensation, are specified in the co-op bylaws. If the cooperative is organized as a limited liability company, also called LLC, new workers are automatically recognized as owners, but still need to go through a candidacy period to increase their membership privileges. In the LLC, the required time and procedures to become a member and details for member compensation are specified in the operating agreement. Once the member candidate meets all their candidacy requirements, they are voted into membership, or co-ownership, by existing members. A new member must then pay a one-time buy-in fee, or a capital contribution, which can be paid upfront or over time through payroll deductions. The capital contribution is similar to owning a share in a traditional corporation, except that a member's share is not tied to the value of the business and does not increase or decrease over time. Cooperatives are created to be a stable resource of profitable work for their members, and they encourage new, talented members to join because the capital contribution is not tied to the value of the business. The capital contribution is equal for all members, and each member is entitled to one vote. The capital contribution is returned to the member if they decide to leave the cooperative. The cooperative carefully tracks these amounts in what is called the collective account to ensure prompt, accurate, and fair payouts. The collective account also contains each member's individual capital account, which also holds all the amounts owed to them. Now that we've covered the basics, let's talk about how workers get paid. Just like in a traditional business, every worker in a co-op gets a wage that can be a per-hour amount or a salary. But unlike a traditional business, workers at a cooperative are simultaneously owners, and owners mean sharing the responsibilities of democratically controlling the business as well as reaping the benefits of their hard work through profit sharing. Once a worker completes their candidacy and starts paying their capital contribution, they join the other members in sharing the year-end profits, also known as patronage. In other words, similar to the way a person patronizes a business by shopping there, members patronize a cooperative by working there, hence the term patronage. The cooperative distributes patronage on the basis of member hours worked, the wages earned, length of membership, how many members joined the co-op after you, or any combination of those factors. In every case, patronage is established to ensure that worker contributions are acknowledged and that there is a fair, clear process for sharing profits earned by the cooperative business. Not all the year-end profits are considered patronage to be paid out to members. Some of the profits are kept or retained in the business so that it can develop and grow, and to assure that the cooperative has enough cash reserves in case of an emergency or an unprofitable year. This retained profit or capital is known as retained earnings. The amount that is retained and how much is allocated towards patronage is specified in the bylaws or operating agreement. Here is an example of why this is important. Miel Bakery Co-op is a cooperative corporation. Their bylaws specify that 20% of gross profits will need to be retained. In 2023, Miel Bakery Co-op made $100,000 in profits. Unfortunately, shortly before the year ended, the bakery's main oven broke. Because they had retained earnings, they were able to purchase a brand new oven that cost $10,000. They also needed new aprons, a new mixer, and they needed to invest in online marketing and brand design. With retained earnings of 20%, which was $20,000 of the $100,000 in profits, Miel Bakery Co-op had enough money to cover the unexpected expenses. This means that the remaining 80%, or $80,000, would be allocated back to the members as patronage. That 80% becomes part of the collective account and is used to calculate the patronage for each member. Patronage is not distributed to members all at once. Instead, it is paid out over a period of time established by the cooperative, often 3 to 5 years. This increases financial stability for the cooperative and assures that profit is fairly allocated over time. Additionally, if a bad year causes many members to leave, paying out patronage over time protects the members who decided to stay. For example, Kind Care Co-op had a high profit year in 2019, so members' patronage was also high. It was a great year. Unfortunately, as no one could have predicted, in 2020, the pandemic hit. The news of the pandemic caused many of their clients to cancel services, and fear of the pandemic caused several members to leave. If the entire patronage had been paid out, the members who left would have taken the benefits from a great year, 2019, and left the members who stayed to bear the full burden of the losses due to the pandemic. This example shows that paying out the patronage over time ensures that the profits from a good year will help keep the cooperative afloat throughout the bad year. This way, the cooperative has a better chance of surviving and recovering from unforeseen circumstances, and the benefits and losses are shouldered fairly among all. Since cooperatives pay out patronage to members over a period of time, their bookkeeping must carefully track the amounts for each member. Remember, the total amounts or profits allocated towards patronage was put into the co-op's collective account. Within the collective account is a special account for each individual member called the individual member account. It contains all the patronage dividends that are owed to that member from prior years, as well as their initial capital contribution. In some ways, members can view their individual member account as a personal savings account. Let's take a look at how Miel Bakery Co-op distributes patronage to their members. Miel Bakery Co-op had $100,000 in profits in 2023. After retaining 20%, or $20,000 of the profits in the bakery, 80%, or $80,000, was allocated towards patronage and is tracked in the cooperative's collective account. Miel Bakery Co-op distributes patronage according to the hours that a member worked. In 2023, Rosario worked 20% of the total hours worked by all members, so Rosario's share of the patronage was 20% of the total, or $16,000. Additionally, at Miel Bakery Co-op, profits are distributed over the span of 3 years, with 50% distributed in year 1 and the remaining 50% after year 3. So, $8,000 was paid out to Rosario immediately, and $8,000 was placed in Rosario's individual member account to be paid out in 2026. In the same year, Alexi worked 10% of the total hours worked by all the members. His share of the patronage was 10%, or $8,000. $4,000 was paid to him immediately, and $4,000 was placed in his individual member account to be paid out in 2026. Both Rosario and Alexi have individual member accounts with the patronage dividends from 2023, but also from prior years when the cooperative was profitable. Planning and budgeting are important to keeping the business profitable for members. Bookkeeping and member review of monthly or bi-monthly financial statements are crucial to helping members make wise decisions. The distinct quality of being both a worker and an owner is empowering. No one is alone in shouldering all of the responsibilities, and members collectively decide how to organize work and grow the business. The Worker-Cooperative is designed to recognize individual contributions while also ensuring that everyone is fairly compensated. Welcome to this unique, equitable way to do business.